September 1, 1990 Real Estate Basics, Joint Ventures. The most popular method of raising equity beyond a simple partnership is a joint venture. The joint venture assumes many formats of equity ownership including participating debt, unleveraged equity and highly sophisticated partnerships delving beyond simple profit participations and risk distributions. Joint ventures normally include developers and investment funds, a blend of real estate project expertise with equity ownership for larger developments. Highly structured ownership rights and profit distributions encompass joint ventures. The funding partner normally collects a minimum fixed return, coupon rate, as a base rate from the annual cash flow and reversionary profits from the sale or refinancing of the project. Depending upon market conditions and equity contributions, profit recapture formulas incorporate any yield shortfalls not covered in annual returns. Joint ventures are ideal funding situations for numerous reasons. The developer conquers larger ventures by attracting more substantial equity contributions. Funding sources lock into investments with income realty characteristics including steady cash flow, bricks-and-mortar collateral, inflation protection and tax benefits, among other factors. Developers usually boast proven performance and track records with sufficient net worth/liquidity available to pay for operating deficits, shortfalls and miscellaneous funding obligations. To be included as a true partner in the project, the developer retains an appropriate financial interest via ownership position and/or guarantees to the lending partner. Most often, the developer has multiple roles including property and construction management as well as marketing. Life insurance companies, pension funds, hedge funds, public as well as private syndicators are the most common joint venture funding sources. Funding sources may be quite active or take on more passive roles within the project. Regardless, funding sources still need to analyze, control and manage projects primarily relating to financial decisions including asset sales and major fiscal shortfalls. Operational and physical project responsibilities remain with developers as long as economic performance is within target range. On the surface, joint ventures are relatively straightforward business propositions marrying equity funds with development talent. However, joint ventures are oftentimes highly technical and complicated partnerships demanding intense financial, tax and legal negotiations based on the following business issues. Partnership goals. Developers and funding sources need to clearly outline compatibilities, profit expectations, timing, risk tolerances, partner nuances and any other concerns. Any philosophical issues also need to be resolved before discussing project dynamics and economics. Capital contributions. Any debt and equity contributions as well as credit enhancements should be clearly defined. Funding sources and developers will give careful attention to contribution timing, cost overrun provisions, developer profits and overhead costs, as well as allocation of other resources done within the development team or transferred to third parties. Profit distributions. Capital contributions are matched according to projected distribution of profits including cash flow tax benefits and equity reversions. Using tax benefits allocated to partners according to needs creates substantial profit opportunities above and beyond normal pre-tax cash flow distributions. For example, pension funds freely negotiate these benefits to developers as these entities are not taxable. And in a 50-50 distribution split, the funding source can pay for improvements and provides a mortgage, while the developer guarantees project performance by funding deficits and overruns, as well as contributing land and the appropriate expertise. Control. Operations and on-site management/leasing, asset management services and overall daily responsibilities should be arranged with the developer and outside vendors as necessary. The partnership may agree to relinquish full control to the developer and asset management control to the funding source which is often syndicated with multiple investors. Of course, partners with more control are entitled to greater profits. Termination. Appropriate documentation helps to assure project termination, either full or partial, is handled quite successfully. This component of the joint venture can be the most challenging as involuntary terminations, for example insolvency, illness and unforeseen market conditions, infrequently are tailored to the original intentions venture. The buy-sell provision within the venture covers most of these issues by specifying various formulas based on a variety of conditions. Miscellaneous features, third-party financing, recourse, reversion options, supplemental financing, partner substitution, recourse sharing and limits are other key discussion points. Each of these points is individually tailored and can include modification provisions within the joint venture agreements. Flexibility is the hallmark of any joint venture as the debt/equity funding formats are custom-tailored in nearly every case. No specific joint venture format is found, as many formulas are available, with four popular structures including standard, leased, mortgage and standby formats. Based on these various formats, funding partners provide either debt or equity tenant financing as outlined below. Standard joint venture. The standard joint venture, also known as traditional, is the most popular format in the marketplace. In summary, the developer and funding source form a partnership to develop and operate a specific project. Standard joint ventures are normally funded with 100% equity upfront. This structure covers all costs by the founding partner. In return, the funding source receives at least 50% or more of the project economic interest, including cash flow participation and tax benefits. Furthermore, the funding source may often receive a cumulative preferred return, which is normally a coupon yield at or below current mortgage rates. Leased joint venture. The leased joint venture is targeted towards the lease as the funding obligation. In effect, the developer is treated as a tenant and the funding source as the property owner. The joint venture is usually negotiated as a net lease with the developer. Under this arrangement, the developer leases and manages the project with rents index the debt to a specific yield to the funding source, typically tied to return on cost. In the event of sale or upon lease termination, the developer and the funding source may negotiate a purchase option or continue as a joint venture in a partial sale to other purchasers. Lease terms often include sharing ownership responsibilities such as cost overruns and capital improvements related to structural repairs and replacements. Debt joint ventures. Debt joint ventures are financial arrangements positioning the funding source capital as first lien mortgage obligations rather than equity contributions. Debt service principal repayments are identical to traditional mortgages with the exception of any cash flow and reversion participation benefits. Interest rate payments are typically fixed rate, while the calculation for the actual rate may be tied to an income or cash flow participation formula. The funding source often includes special provisions for equity conversion as well as purchase options up the developer's ownership position. Of course, the funding source will control the sale and refinancing. For the most part, debt joint ventures are similar to convertible mortgages. However, the funding partner exercises property ownership rights in contrast to lending rights. Project ownership control formulas are based on loan-to-value ratios. At conversion of debt to equity within this format, the funding partner liquidates the debt and converts to equity. Standby joint ventures. In a standby joint venture, the funding source's balance sheet is the key contribution to the project. Rather than actually funding the transaction, the funding source commits to fund the project as a joint venture partner based on specific performance thresholds, mainly project completion. Using such an arrangement, the developer can readily obtain construction or other type of temporary financing to complete the physical and economic elements of the project. For example, speculative development projects are targeted for this type of funding vehicle as limited options are available to regular joint venture and conventional financing channels. As remuneration for pledging the financial creditworthiness of the funding partner, a substantial equity position is available. Upon completion or renovation, the developer and funding source share the profits of the sale or refinancing without necessarily taking down the standby commitment.